All right, I'd like to invite you all to our very special keynote presentation here. Tobias, I met him a few years ago at another event, and just really hit it off. Happens to also be an LA local. And I'm not sure if many of you have read any of his books, but he's written a lot about value investing and how billionaire investors have really made their money in the markets. And without further ado, Tobias can speak for himself much better than I can. So with that, I'd like to introduce Tobias Carlisle from the Acquirers Multiple and Fund.
Thanks so much, Bobby. I'm Tobias Carlisle. I'm the principal of Acquirers Fund. It's a RIA, SEC-registered RIA in Los Angeles. It's a terribly cheesy name for that book, and I'll tell you why that happened in a moment. But I'm a deep value investor, and basically that means paying less for growth than other folks might, and I'll tell you why I do that as we go through. I've written a number of books. The first one I wrote was called Quantitative Investing. I wrote that with Wes Gray, who runs Alpha Architect. Some of you may know Wes. He's a PhD from Booth. We found every bit of academic and industry research that we could find on fundamental analysis and value investing, and we tested it, found the stuff that works and the stuff that stopped working, and wrote a book about it. And one of the really interesting things that I noticed in that book was that unpopular ideas, money-losing stocks tended to underperform the money-making stocks. And just an interesting kind of idea that this world is a little bit inside out and upside down, and I wanted to know why. And so I wrote Deep Value, sort of explaining why, and then realized sort of halfway through that process that portfolio construction is a very important part of value investment. It's more than just picking the right stocks. You have to make sure that they're appropriately weighted in the portfolio, that you're sufficiently diversified, that you concentrate into the right things. And so we found some investors who had been successful over a 25-year period, who'd outperformed in a concentrated way, and interviewed them. And they included people like Charlie Munger, Lou Simpson, Christian CM, who's the Nordic car icon, and a variety of other guys. And we talked to them about what they did to outperform, and that was Concentrated Investing, which is the book that people seem to like the least for whatever reason. And then most recently, the Acquirers Multiple, which came out last year, which is in 2017, which is the simple explanation of all of the other books. It's written to a 5th grade reading level. You can read it in 2 hours, and I think it's a fun read. But you know, your mileage may vary. I've given a variation of this talk at. You can see it on Google. I gave a talk at Google. I've spoken at Harvard and Caltech and New York Society of Security Analysts and the CFA version of that, and so on, which is all really fun. So in very simple terms, this is the strategy that I use. You may know of Joel Greenblatt's book, The Little Book That Beats the Market. It's the best-selling book on value investing in the last decade or so. It came out in 2006. Greenblatt advocates for this approach to investment, which is a quantitative version of what Warren Buffett does. So Warren Buffett famously says he buys wonderful companies at fair prices. And if you read through Buffett's letters, as I'm sure almost everybody in the room has, you see that wonderful companies are, of course, companies with a very high return. Well, Buffett says a sustainable high return on invested capital. And then he talks about valuing companies on the basis of EBIT, operating income. Naturally, he's using enterprise value. Greenblatt combines those two together and says, if we just naively buy a basket of these stocks, can we generate outperformance? And he found in the book, looking at a 12-year period of data, that it did in fact lead to outperformance. And there's a lot of criticisms of it over the years that he was focused on companies that were too small, that were too illiquid. So we tried to put that to bed in Quantitative Value, and we did all of the things that you would do to test the strategy to make sure that it actually does work. We look at in a very big universe, so it was $1.4 billion and above. And we then market capitalization weighted the portfolio, which means that the most money goes into the biggest stocks. We rebalanced using data that had been lagged by 6 months. So you take the K data and then you buy in June. So it's all been disseminated to the market. Even applying those stringent rules to this strategy, it does outperform materially. And we used a full data set that's available through CompuStat, which starts in '63, and it ended in 2011 when we ran it. It outperforms over the full data set, delivers better performance than the market at a lower risk, so you get better risk-adjusted performance than the market. The wrinkle to it is, and this is the magic formula through the data set that we tested, considerable outperformance against the equivalent universe. Return on invested capital, which is one leg, as I discussed before, this is the wonderful company part of the analysis. If you use that by itself to select stocks, it does in fact outperform the market, but it underperforms the magic formula, which is sort of a curious idea. And the reason for it is that the value factor delivers all of the performance and more. And so I call that value factor the acquirer's multiple, because it's sort of the way that a PE company or an activist might approach a valuation to look at what are we in fact paying. Because if you look at the market capitalization, that's one very simple part of the analysis. Then you want to see if there's cash on the balance sheet, are there liabilities, are there preference shares, are there underfunded pensions, and so on. Anything that's a genuine cost that an acquirer of the company its entirety must endure or must carry. And then on the other hand, you get access to all those cash flows that you can direct to paying down debt or to improving the capital structure, whatever you prefer to do with them. So that metric leads to better raw performance. And it turns out that that's no fluke that it does that. We can apply different mixes of quality and value. And you can see on this side, 100% return on invested capital, that's the red one that I showed you on the screen before, delivers the worst performance. And as you add more value in the sense of EBIT, TEV, or acquirer's multiple, as I like to call it, you get increasingly better performance, and it outperforms the market, which is the same universe as the stocks that it's drawn from. I always get questioned at this point, what if we take an average of return on invested capital? What if we take an average of the enterprise value? What if we use different value metrics? What if we use a different ROIC? It doesn't make any difference. It delivers the same results. This is what the performance chart looks like. It's quite consistent outperformance over the data set that we have. There are notable periods of underperformance though, and there's one right there, which is the early 80s, just before the stock market took off and boomed. There's another one, that's the dot-com boom. Some of you will remember that, some of you will have read about that. And more recently, there's been a very long and extended period of underperformance, and it almost perfectly matches when the little book came out. So that's an interesting possibility that it did in fact lead to the underperformance. This is the same chart as before. I just took away the log axis, so you can see that it does deliver material outperformance over the full data set. This is the liar chart though. The log chart is the one that makes the most sense. And these are the statistics. Better compound average growth rate from the acquirer's multiple, but also improved risk metrics to the extent that you use volatility as risk. Many people do. It does deliver better returns that way and lower correlation with the market. So the question is why? What I've shown you is basically that was quantitative value. The question is why, and the answer is that there is this very powerful mean reversion in the market. So this is an interesting study undertaken by Michael Mauboussin. He ranked every company in the Russell 1000 by its return on invested capital, and then he divided them into 5 buckets. The bucket on the very top is the companies with the very highest return on invested capital. The bucket on the bottom has the very lowest return on invested capital. And what you see over the data set is that the companies that have the very highest return on invested capital tend to trend towards the mean, and so do the companies at the bottom. They tend to trend towards the mean over time. He updates this on an annual basis, on a rolling basis, and the answer is almost always the same, although there's a little kink at the moment because of the most recent performance of the market. So that that really is the difference between Greenblatt's approach to investment and Buffett's approach to investment. So Buffett, of course, is looking for sustainable return on invested capital. And he spends most of his time, if you read his letters, most of the time in the letters, he's sort of devoted to this meditation on what a moat is, how you find a sustainable competitive advantage, what that means. And he tries to define that in various different ways. Not possessing Buffett's sort of genius for identifying them, Michael Mauboussin has written a series of papers where he tries to take a sort of scientific approach to identifying them. So what can we identify a priori? What can we identify before the fact that will lead to sustained return on invested capital over the full data set? So there are these companies that do resist mean reversion. It's about 4% of the data set. The other 96% are mean reverting. So what qualities do these 4% possess that allows them to outperform? And over 3 papers that probably weigh in something in the order of 45,000 words, he decides that there is no way to make that determination. He looks at DuPont analysis, tries to devolve is it a high turnover of assets? Is it a high margin? There's no rhyme or reason to it. All he can say at the end of the paper is that they tended to be in pharma, although that may now be ending, and they tended not to be in retail, and that may now be ending. When I'm constructing a portfolio, that's the long portfolio then contains companies that tend to be very cheap on those metrics that I discussed before. It's not a great way to short. It's part of a short, but it's not sort of the full answer to shorting. If you've tried to do any shorting, if you've tried to do it over the last decade, it's been incredibly difficult to do it for the reason that companies that have terrible financial statements have tended to do quite well. And the best example of that is Tesla until more recently. But there are other examples of that. Netflix is one, Dropbox is another, Snapchat is another. If you look at the financial statements of these companies, you might put a short on them. That's almost always been the wrong answer. And so in addition to overvaluation, in addition to all of these things that I discuss here, so we look for earnings manipulation. So these are tests that we do on every single stock that goes into the long portfolio or the short portfolio. So the long portfolio won't have any earnings manipulation, won't have any financial distress, won't have any fraud. We apply that test at the very beginning to the full universe of stocks that we would then look at. And we find that if you eliminate earnings manipulation or stocks with the characteristics of earnings manipulation, financial distress and fraud, over the rest of the cohort that is left, the other 95% of companies, you get about 2 points of performance additional over the market every year. When you form a value portfolio using the acquirer's multiple, you don't find that there's a great deal of overlap for the reason that there are already companies that are biased towards holding more cash, generating real cash flow and so on. A heavy debt load is something that indicates that something is a pretty good short, and lots of off-balance sheet liabilities. All of these things seem to go hand in hand. When companies get into some trouble, that's when you find, so financial distress tends to lead companies to earnings manipulation. Earnings manipulation is a gateway drug to fraud. You don't really get into much financial distress if you don't have debt or off-balance sheet liabilities, which is just debt that's not very well captured on the balance sheet. There are lots of companies out there that have negative operating income that do tend to go up year after year after year. I wouldn't buy them, but lots of people do, and it's worked as a strategy for a really long period of time. So it's a good way to short, but not all of the time. And then you want them funding themselves, not through their business operations, but by selling stock and raising debt. I've basically described Tesla there, and that's a bad short until more recently. And so the final thing that I have learnt over the last 5 years, and I wish I had learned it 5 years earlier than that, is to apply a momentum overlay on top of that. So all we do is we make sure that the stock is not up over the last 12 months. And I think that that sort of indicates that a company, that the investors in a company, the shareholders in a company, are getting tired of the narrative. that they're starting to look at the financial statements, that they're not prepared to just continue to bid up the stock when the fundamentals are deteriorating materially. And so that's why that kept us out of Tesla until more recently. Tesla's momentum broke down about 9 months ago. It still was an ugly holding period for a lot of that. It was up and down through that period, but it's not that sort of stock where you're in it and it's up 30% at each quarterly because the results are so good, or the earnings are so good, or the earnings picture that they paint is so good, even though the rest of the fundamentals are so terrible. So I think that helps keep you out of stocks that are, as a value investor, you might look at that and say that that's a terrible idea, but most people aren't analysing stocks in that way. They're looking at the narrative, they're imagining the future when all of the current troubles are over and everybody in America drives a Tesla, everybody in the world drives a Tesla. The problem is that you have to fund those things, and it's very, very hard for a fundamental investor like me to see how they're going to do that. This is a back test of what I've just described, that over time the shorts do tend to lose money, but you have them in the portfolio because they give this performance where when the market is drawing down, which is the red, the shorts will stand up, and this is a 1/3 weighting. So this is a 30% weighting in the portfolio. So you hope that the shorts deliver some performance, and as you're rebalancing through that period, you get this Shannons Demon idea. So Shannons Demon is Claude Shannon, who's the father of information theory, gave us bits on and off, the father of all computation. He also liked investing. He was a heavily concentrated investor, but he didn't apply this in his own portfolio, but it's still a very good idea. Basically, if you have two anti-correlated assets and you move from one into the other, the portfolio will have better return characteristics than the underlying assets. So one extreme example of that is you can have two assets that eventually go to zero or trend down the entire holding period. And as long as they're anti-correlated, the portfolio will trend up. The portfolio will make money because as the one asset goes down, you put more money into it and you take it away from the asset that's gone up. And then as they anti-correlate, you take away from the asset that's working and put it into the asset that's not. So the portfolio grows over time, and that's known as Shannons Demon. So value investing, rebalancing longs allows you to do that, and rebalancing longs and shorts also allows you to do that. It's been a very rough run for value. I'll show you in a few slides what that looks like, but this is in the S&P 500, just looking at two different growth and value, the S&P 500 growth and value portfolios. Since about 2007, which is about 12 years, we're now approaching underperformance that's in the order of what we saw in the dot-com boom, but it's taken a much longer period of time, so it's been trying for value investors to survive, and many haven't. Many have closed shop. That's a meaningless sort of statistic if growth is the place where you want to be. Maybe they are better companies. The growth companies are better, or the glamour companies rather, I shouldn't say growth. The glamour companies are better companies, and the value companies are rightfully value traps, and they should be left to wither and die. This is FAMA French data, Ken French, from the Ken French website. This is price to cash flow. I can show you the same thing with price to earnings or price to book value. If I show price to book value, I'll hear all the arguments for why book value is a bad metric to use, and I agree it is a bad metric to use, but price to cash flow is a popular metric. The blue line is the outperformance of value over growth since the beginning of this data set in 1951. You can see that it's been pretty consistently in value's favor over that full data set. So this is buying the companies that have the lowest price to cash flow on the longs, on the value side, and the highest price to cash flow on the glamour side. There are notable periods where it hasn't worked. The late 1990s was one, and then there's this very bright red blood running down the right-hand side, and that's the current period. It's been extremely difficult to be a value investor using price to cash flow through this period. The reason why I think that this has occurred is there was a very good run for value from the early 2000s to around 2007, and it led to enormous flows to value. And this curious thing happened that value became more expensive than glamour in 2010. So you can see December 2010, it dips below the line there. So the value portfolios were more expensive than the glamour portfolios, and it led to very bad performance. We're now at this point looking back roughly 40 years where it's historically wide, the spread between value and growth, and that has typically led to very good performance for value. So the 50th percent, so we're at about 50% along this line. It's a little bit wider now. And that's the 50% line there, and that's the growth over value. So this is better performance for value over growth. So I'm happy to answer any questions that you might have.
So you had this one chart where you plotted the ROIC.
Which one?
Yeah, you basically used, on the y-axis, you had ROIC minus WACC, was it?
Oh, yeah.
And that's essentially, the EVA, right?
This one?
Yeah. So what exactly are you trying to say here? Because you kept referring to ROIC rather than the differential. So
Right.
Because the WACC changes, right, depending on the company. So it's a spread. So I'm just trying to understand what exactly.
It does. I think sometimes it's a little bit of double counting, but you're right. It's a margin rather than pure ROIC. But this is not my chart. This is Maveson's chart.
Right. But what is he trying to say?
He's talking. I mean, in this, he's trying to adjust for the quality of the company as the market perceives it.
So he's saying that the margin is basically mean reverting for the quality companies, is it?
It's mean reverting for all of them. It's mean reverting for high return on invested capital. It's mean reverting for low return on invested capital.
I thought it was very interesting that you suggested putting in terms of shorts, putting a sort of a momentum sort of overlay. What about putting like a momentum overlay on this sort of growth versus value reversion? Why not just wait until value has 1 year when it outperforms growth before going back into this value versus growth?
That's a good question. It's not one I've tested, but it's a very good question. I don't know that necessarily. Well, there have been short periods where value has outperformed. Any time that value is trending up, it's outperforming, and so that hasn't been the solution. I mean, that worked well there. I don't know. You mean like apply some sort of moving average or something like that if it gets above the moving average?
Just get some of these head fakes out of the way. I'm just wondering. Everybody always wants an all clear, right? That's what everyone's always looking for.
I don't think you're going to get one, but I agree with you that's an appealing idea. But I don't think it would have worked because I think you would have been caught out in these. Like, I mean, I've felt every single one of those. Hoping and praying that was in fact the one that was going to. But it hasn't been so far. Sam's just.
A lot of your charts talk about value versus growth, but like Harlan Craig also, in their analysis said small beats big.
Yeah.
Can you talk about some of the, have you looked at that data at all? Especially speaking of MicroCap conference, looked at MicroCap data?
So the answer is not a happy one. That anomaly almost seems to have gone away. And I think that Jim O'Shaughnessy in his What Works on Wall Street talks about that a little bit. And there's a Loughran paper looking specifically at enterprise value to EBITDA, the enterprise multiple. The difficulty when you get to very small cap stocks is the bid-ask spread makes it very difficult to determine where you're trading. Are you in fact capturing outperformance, or are you assuming that you can trade at the bid or the ask when you can't in fact do that. So what they do is they try to exclude those smaller stocks. I think what Jim O'Shaughnessy showed, and that they applied the same analysis in Lofgren, is once you exclude those very, very small stocks that are uninvestable for, and this is probably the best news for you guys, like uninvestable for bigger investors, for bigger assets under management, that they become, that small minus large effect seems to go away. The only place where so this is the problem with price to book, the only place where that outperformance seems to occur is in a decile that's far too small to be investable. And once you control for that, price to book seems to stop working as well. That's not true of enterprise value. It's not true of the enterprise multiple. That seems to scale. It doesn't matter which. You can use it in the S&P 500. You can use it in S&P 1500.
And then how do you define the decile that's uninvestable? What market cap is that?
That's not my words. Yeah, it was the smallest 6% of companies. So I think that's roughly. So the smallest 6% is roughly. It could be almost Russell 2000 because 94% is Russell 1000 is about 94% of.
Russell 1000 is what? 94% off?
Right. S&P 1500 is 90% of all companies by market capitalization. So the S&P 200 is about 6% of market. It must be below the S&P. Sorry, it must be below the Russell 2000.
Below the Russell 2000.
Yeah.
Exactly. No, I think Ian Castle, he at the study that he pointed out, in which he said that those 6% or whatever, the smallest, those are the ones that really outperform. So if you exclude them, then the big minus small.
It stops working, but they do in fact work. They do.
It may still work, but it's much lesser.
It does. That lowest 6% does seem to work. The problem is that it's not entirely. Nobody can be sure if it's just some anomaly in the bid-ask spread about the way that it's being captured, about the way that it's being studied, rather than an investment effect that you could capture.
And then I also want to ask you the impact. Do you have any thoughts on the impact of ETFs and whether that's caused a greater spread between value and growth?
That's a really good question. So there's some Michael Green, who's at Teal, and Chris Cole, who's at Artemis, have this sort of ongoing apocalyptic scenario where they've built these models where they say, let's assume that the index, the passive index, just gets these flows constantly. And fundamental investors have in the past been sufficiently big to kind of push the index. Like if anything falls outside, they push it back in. They have this mean reverting impact on it. They say, what now happens if the index becomes the passive becomes so big and it's just relentlessly buying the most overvalued, biggest stocks? Because that's what it tends to do. I don't know if that's an effect of ETFs or not, if it's just a trend towards passive. They have this apocalyptic scenario where it never mean reverts. And they have some tipping point, and it's like, I forget whether it's 30% or 50%, but there's some tipping point where passive becomes too big and it's lower than you think, where it never mean reverts. I don't necessarily subscribe to it because they're both sort of somewhat apocalyptic guys, but it's an interesting thought. I don't think it's the fault of ETFs though.
The traditional definition of value versus growth is your price to book, right? But how relevant is that nowadays, given that so much of a company's assets are intangible or knowledge-based workers? So is this something that we should this divergence between growth versus value, is it even a useful metric anymore?
Book value is not a useful metric. Accounting changes have basically meant that book value has stopped working. And I think O'Shaughnessy has written some great papers on this where they talk about hidden value and veiled value, I think they call it, where there are companies that have been so successful over time and bought back so much stock they've now got negative book values. And McDonald's, I think, is an example of that. So if you ask price to book value to categorize it, it can't do it as an overvalued stock or an undervalued stock, so it just misses. And you can perform this analysis yourself too. You can look at the cheap decile and price to book and then run any other metric over it, and all the other metrics will disagree that they're undervalued companies. The thing is, that's a new argument about it that I've heard, but that's always been the case. I mean, the argument for price to book working was that it was a stable, book value doesn't change much on a year-to-year basis, whereas earnings are sort of wildly up and down. So if you know that the book value has some sort of earning power and you'd expect it to normalize over a period of time, it makes sense to buy them cheaply. Tangible book value does seem to work, but book value has stopped working. And smarter people than me seem pretty convinced that that's the way it's going to be, so I'm inclined to agree. That's why I show this one with price to cash flow, just because I think that more people, value investors, fundamental investors, want to look at cash flow as an arbiter of value. So I use that. You get the same answer using the book value data and the price to earnings data.
This is price to free cash flow or operating?
It's the Fama French definition. I think it's operating cash flow, because free cash flow is, that depends on the decisions that they're making about dividends and so on. I think operating cash flow is a more stable, standardized measure.
The book you mentioned, Concentrated Investing, which you said wasn't really that popular versus your other books.
Yeah.
Can you talk about some of the key takeaways, I guess, from that book in terms of the concentrated investors and what they did to outperform?
Yeah, so I had the most fun writing that book because it talked about these guys who are long heroes of mine. So I get to see what they do. I think the most interesting part of it was the discussion about Kelly criterion weighting, Kelly betting. So Ed Thorpe is the first person who sort of applies the Kelly criterion, and he says you can use that edge over odds, and if you're a value investor, you can reverse engineer that to work out the edge that you have in a particular company by its undervaluation, and you can look at the odds offered by the market, and you can come up with a sort of scientific answer to how much you should invest. And so Monish Pabrai writes a great book about it in the Dando Investor. He says Stewart Enterprises, which was the funeral home, at the time he invested in it, he put in 10%, and it did well. And if he'd used Kelly, he would have put in 90%. And everybody knows that Buffett does it. They read the Dando Investor. They start applying it. At a value investing congress in Pasadena, Ed Thorpe's son attended, and he heard everybody talking about using Kelly. And he went home and he said to his dad, who's a mathematician, everybody's using Kelly. And Ed says, well, that's wrong. And because he's a mathematician, he writes this mathematical proof, and it's available on the internet. You can go and read it. It's a really well-written paper for a math paper. I find it incredibly interesting because he says that analysis is wrong, and he gives these reasons why. And the first one is that the nature of Kelly betting is that it's, if you're playing blackjack, you get one hand at a time. And you get to make your decision. You've got a bankroll. You can make a calculation, place your bet, right or wrong, move on to the next one. So the theory of Kelly, just in case you don't know, is that you should never bust yourself. You never go to zero. Kelly never risks ruin is the idea. And it gives you the highest rate of geometric growth. That's what it's seeking to achieve. So there's lots of criticisms of it, but I think Ed's is the best one. And he says, or Professor Thorpe, I don't know him, I don't want to pretend like he's a close personal friend. In the paper, he says, when you're doing that analysis, not in series, but in parallel, which is what a portfolio is, right? You have a group of all of these bets going off at the same time, and you could easily have two bets that should be bigger than 50% of your portfolio. What do you do with that? And he says, well, if you think about that, any positive expectation bet should therefore be in your portfolio, and you can think about maybe you should have some treasuries, maybe you should have some gilts, maybe you should have some gold. And if you do that, then you have to size down your bets because Kelly never risks ruin, and so you have to. And what that means is that any bet has got to be much, much smaller than what Kelly by itself would say that it has to be. So that's his main point. But then he says also, you can't get mathematical precision. You're ignoring things like black swans that are rare, high impact events. And those are the three criticisms, and I think they're very good ones. So I think the takeaway from that book for me was that Kelly is less useful for value investors. And for me, I think about, so my universe is about the S&P 1500, and I'm trying to buy 30 longs and 30 shorts. So I'm already so the decile's 150, 30 of that is a fifth, so I'm in I'm in a fifth of a decile and I'm trying to work out which one of those is a better bet than another one, and I think it's almost impossible to do. I think there's more randomness in there than that. And that's why quant portfolios tend to be quite big. But I'm not quant, I'm sort of, I hate the word quantamental, but probably that's right. Like screen heavy and then do some diligence on top of that, some forensic accounting due diligence, as I like to call it. But if you're doing that and you're getting that concentrated, it's hard to say that 1 is that much better than 30, that it should be weighted that much more heavily than 30. And so I equal weight over 30 positions. The funny thing is that if the book pulls out Graham says 30, Klarman says 30, Munger says 3, Buffett says 10. All of these guys have different numbers, and I think that they're all roughly right. If you look at the academics, they say you get rid of all of the non-diversifiable risk at somewhere between 25 and 30. So I think that the correct answer, to the extent that there is a correct answer, is you need to buy about 30. No more than 30 probably, and probably no fewer than 10. And I think you get between there, it's sort of taste. How much volatility do you want in your portfolio? How much volatility can you stand? Thanks very much, folks. I really do appreciate you coming here before going to the bar.